We'd like to thank Commissioner Aguilar again for hosting us and for his insight on some of the big issues that we're going to be discussing today. Our next group, or actually our first panel, is really going to be focused on issues of expansion. How do we get more people involved in retirement plans in the first place? A lot of the press that we read about is about perfecting the existing system, making it better in terms of transparency, making sure that people who are currently invested in retirement plans right now are getting the most out of it and are dealt with fairly. And those are all obviously really, really important issues. But what's equally important, I think, is how do we expand the system to include people who are not currently in it, and what sorts of things are being done right now. What's working, what's not working, and the panel that we have, I don't know that we could get better folks to address some of those issues. I'm going to introduce our moderator, Susan Nash. Those of you here at the SEC will likely know her. Those of you who are not may not know her as well. And then Susan will introduce our panelists and moderate the group. She's the Associate Director in the Division of Investment Management for the SEC, and she's responsible for a wide variety of regulatory matters that affect the asset management industry. Her areas of expertise, and I'm going to read this verbatim, include disclosure policy for mutual funds and other types of investment companies, as well as the regulation of variable annuities, variable life insurance, and other investment products issued by insurance companies. Given my background, those are all things near and dear to my heart. Susan has been responsible for many of the SEC's disclosure initiatives under the Investment Company Act, Securities Act, and Exchange Act that affect mutual funds and other investment companies. These include Mutual Fund Summary Prospectus Rule and the Summary Portfolio Schedule in the Mutual Fund Shareholder Reports. The numerous initiatives she led also include initiatives in the area of performance and expense reporting, mutual fund advertising, and implementation of Sarbanes-Oxley for investment companies. Previously, Susan held a number of other senior positions at the SEC, both within the Division of Investment Management and in the Office of the General Counsel. She was an attorney in private practice for several years before joining the SEC. She received her BA from Notre Dame, her master's from University of Chicago, and her JD from Harvard Law School. So without further ado, we've gotten a chance to know each other very well in preparation, but I'll turn it over to you, Susan. Thank you.
Thanks, Keith. Before I introduce the panelists, I want to repeat what Commissioner Aguilar said, but on behalf of myself and all the SEC panelists on this panel and all the SEC panelists all day long, so we don't all have to repeat it, and that's that our remarks, the remarks of all the SEC panelists, represent our own views and do not necessarily reflect the views of the Commission, any of the commissioners, or any of our colleagues on the staff of the Commission. Today's discussion will examine a variety of challenges in increasing participation in retirement plans. We'll look at challenges and ways to overcome the challenges that confront employers in establishing plans and that confront employees in deciding whether and at what level to participate and how to manage their investments when they do participate and also when they exit the plan. Without further ado, I'd like to introduce our panelists because I'm joined today by a distinguished group, and I would like to get this to them as quickly as possible so that you can hear their views. To my immediate right is David John. David John is a senior strategic policy advisor at AARP. He also serves as the managing director of the Retirement Security Project at the Brookings Institution, which focuses on improving retirement savings in the United States, especially among moderate and low-income workers. David is a co-author of the Automatic IRA, a small business retirement savings program for firms that do not sponsor any other form of retirement savings program. He is also a co-author of a proposal to include annuities as the default withdrawal choice in a 401k type plan. Among his other activities, David has testified before a number of congressional committees on retirement issues and is a co-editor of the 2000 book, Automatic: Changing the Way That America Saves. To David's right is Judy Maris. Judy has served as Deputy Assistant Secretary of the Employee Benefits Security Administration of the Department of Labor since October 2013. She joined EBSA after an extensive corporate career. Most recently, Judy was the Chief Investment Officer of Alliant Tech Systems, Inc., where she managed the investments of the pension savings and VEBA plans, so she has definitely got some on-the-ground experience. Prior to joining EBSA, Judy was the Defined Contribution Committee Chair of the Committee on the Investment of Employee Benefit Assets and a member of the Plan Sponsor Advisory Committee of the Defined Contribution Institutional Investment Association. Earlier, she was chair of the ERISA Advisory Council, as well as a loaned executive to President Carter's Commission on Pension Policy. To Judy's right is John Farinacci. John is a recent entrant to the SEC. He joined the Asset Management Unit of the SEC's Enforcement Division in November 2011 as a fellow with a specialty in mutual funds. But John has a long history before that. He has more than 25 years of experience in the financial services industry, most recently at Fidelity Investments, a leading provider of 401k savings plans and IRAs. John served as Chief Financial Officer for one of Fidelity's business units. And to John's right is Jeremy Coe. Jeremy has been a senior economist in the Division of Economic and Risk Analysis at the SEC for the past 4.5 years. His research specialization is in the areas of household and behavioral finance, extremely relevant to the topics we're discussing today. At the Commission, Jeremy has played a role in initiatives related to retirement investments, such as the Commission's rule proposal on target date funds. And I worked closely with Jeremy on that initiative and definitely appreciated his counsel. Jeremy received his PhD in financial economics from the Sloan School of Management at MIT in 2002, and he was an assistant professor of finance at Penn State University before joining the SEC. With that, I will turn the mic over to David John, who will lead us off this morning.
There we are. Technology has always been such an interesting mystery. Well, thank you very much. Especially thank Keith for putting this together and the Commissioner for leading it off. I have noted already not to try to follow the Commissioner in programs if I can avoid it, because I'm not going to look anywhere near as good in that. We, in all discussions of assets and retirement savings security and things like that, presume the presence of assets. If you don't have the ability to save or build assets, basically you've lost. You're out of the picture no matter what. We have, at this point, far too many Americans of all ages and groups who are not currently able to save for retirement or to build assets or the like. And this is a problem that if we don't resolve, we're going to find comes to bite us in a big way. We at AARP did a survey in Washington State this past fall, and one of the findings that distressed me, among others, was the fact that when we looked at Washington State residents, which is a relatively affluent group compared to people in certain other states. We found that 25% of the individuals between the ages of 45 and 64 had total savings of under $25,000. Now, EBRI, the Employee Benefit Research Institute, has done similar studies and has found even larger proportions nationwide of individuals who are at the very least mid-career or beyond, and who should be on a target to build retirement security and have a minimal amount already, and the opportunity to build more declines as they go forward. Because obviously when you're saving for retirement, you want to start young and you want interest on interest on interest, or earnings on earnings on earnings, to actually get to your goals. We can discuss the exact percentage, and the exact percentage really isn't very important. It all depends on how you define the term labor force. If you look at it, full-time employees between the ages of 18 and 64, if you include part-time employees, if you include people with intermittent work histories and the like. The percentages vary. If you look at some of the Department of Labor statistics, it comes to about 50%. If you look at various industry statistics, it's somewhat higher. But regardless of this fact, we're talking about tens of millions of Americans who are not saving and who don't have the opportunity to save for retirement at work. Now, we can all sit back in our grand offices and say, well, that's fine. All they have to do is start an IRA. But the simple fact is that the best estimate I've seen of individuals who could just go out and open an IRA and who save consistently is somewhere about 1 out of 20 or so. I mean, it might get down to 1 out of 14 or something along that line, but that's not exactly a positive number to look at. If we look at the groups who are most likely to undersave and most likely not to have sufficient assets, there are 5 of them: women, younger workers, members of minority groups, employees of small business, and lower income workers. These are not groups that we can afford to ignore. And this is not just a national problem, as I'm going to get into in a moment here. Yes, if we have sufficient numbers of people who are in deep trouble when they reach retirement, there will be pressure for a national solution. I will say that as I get older, I'm increasingly grateful that we as a society generally don't allow senior citizens to starve in the street. However, this is not just a national problem. This is also a state and local problem, because if we have significant numbers of people who don't have enough assets, there's going to be a huge boost in demand for health services from the state and local government, for housing services from the state and local government, for library services, for you name it, and it will go on there. This is a national problem, but it is a problem that affects governments at all levels. It also, if you lack the ability to save, it's not just a matter of young people or people who've never saved before. It also includes mid-career people who, in my state of West Virginia, for instance, will leave the state to join a Fortune 500 or something like that and may save for a period of time. But if they come back home, they are in a small business environment where they're much more likely to find themselves without the ability to continue to save at the time they most need to build sufficient assets. Now, we have a tool. It's a very popular tool. It's called automatic enrollment. Automatic enrollment, as you're going to hear a little bit more later on, is regarded as one way to boost participation, and it does. We're part of a group called Retirement Made Simpler, with an R at the end, because somebody else got the other website first. And we did a poll, the only known polls of people who were auto-enrolled and either stayed in the system or not. The numbers are revealing. 95% said auto enrollment made savings easier. 85% said I started saving for retirement earlier. Amongst the roughly 85 to 90% who were auto enrolled and stayed in, and these are employees, not employers. 97% of them, it's like a North Korean election, said they were satisfied with the process. 98% of them said they were glad my company offers automatic enrollment and the like. Amongst the 10 to 15% who opted out after being auto-enrolled, 90% said they were satisfied with the process. 79% said they were glad their company offered the opportunity. I mean, this is a big opportunity. This is a big boost. It is something workers want. But if they don't have access to a retirement savings account at work, they're not going to have the opportunity to use automatic enrollment either. Now, this is actually a much better week than last week for Keith to have organized this, because we had the announcement of the MyRA, or for those of us who like the works of Gore Vidal, the Myra account. The MyRA is a tool. It is an important tool. It allows first-time savers and companies to deal with the small account problem, the problem of small balances coming in and then being eaten by administrative fees and the like. It is a crucial element to the start, but it is not the solution. Part of the solution, as the President mentioned in his State of the Union address, is the automatic IRA. I got real brownie points from my younger daughter when he mentioned that on the speech, needless to say. But Congress has not acted on the automatic IRA. They are not likely to act on Senator Harkin's new proposal, which has many positive features to it, and I'm still going through it in detail, but I find a lot to like in that. Barring that, we are seeing states, and the states are actually starting to act here. California and Oregon have passed laws setting up commissions to design retirement savings programs that meet the specific needs of their states, and they're going to go forward with that. We have somewhere between 9 and 14 other states that are in various processes of examining this. Washington State is looking at something called the START program, and next week I get to go down to my state capital in West Virginia to look at something called VERA, Voluntary Employee Retirement Accounts. These are important steps to fill the gaps in retirement savings. Now, we can turn around and say, well, everything is working fine, and that the private sector is dealing with this in the way it is right now. But if you are in the private sector, you are judged on results. If your results are good, you get a bonus. If they're too good, you might get investigated in this building, but that's another thing. If you fail, you either get re-educated or you get removed. Now, the data that we have right now shows that the current retirement system works well for a certain segment of the people, but the coverage is not universally there. Either this is something that we must deal with on a state level, and the states are being very smart in dealing with this because they're going to bear some of the costs if they don't, or we deal with it on the federal level. Retirement savings in a DC-oriented system, which is what we have for better or worse, must be available by payroll deduction, which is every income level says is crucial to their participation from the day a person goes to work until the day that person retires. If we don't fix that problem, then we face a myriad of others. Thank you.
Thanks, David. That was a very interesting tee-off to the rest of our panel, and a great kind of introduction on analysis of one of the key stumbling blocks to broader participation. So with that, let's turn it over to Judy.
Good morning, everyone, and thank you for having me. excuse me, until life until 3 months ago, as Susan mentioned, I was entrenched in corporate America as a chief investment officer managing my company's defined benefit and defined contribution plans. For the last 3 months, I've been the deputy director at EBSA. So I'm going to try and segment my brain between the chief investment officer's brain and the regulator's brain, and sometimes I'll cross those lines together, but I'll try and distinguish, because the comments I make today are really framed through a career of experience as a chief investment officer. I've watched as the defined benefit plan with the passage of ERISA grew in terms of funding and its impact on the capital markets and the investment management business, and its ultimate decline for reasons we could talk about later. But with the emergence of a supplemental savings plan that came through Section 401k of the Internal Revenue Code, which has now become our nation's primary retirement plan. Converting a savings plan to a retirement plan has some challenges. I want to talk about a couple features of the defined benefit plan that we all loved. One is the benefit was defined. I knew exactly what it was. And in fact, I got a statement every year that said, if you were going to retire today, here's the benefit you'd get. And almost everyone I know kept that statement. In fact, I laugh that I still have, years of benefit statements that I saved for some goofy reason. But they communicated to me what my retirement was going to mean to me. And I knew that throughout my career. One of the, and the normal form of benefit was an annuity payment. I got a regular benefit check, which was just like my company paying me an annuity. And now we talk about a supplemental savings plan. What do you know from a savings plan? You know exactly what your balance is. It doesn't tell you what that means to you as a retiree. So one of the initiatives that I was keen on in my corporate life, and turns out is important to the Department of Labor, is the notion of what should be on your benefit statement for your 401k savings plan. Prior to the Pension Protection Act passage in 2006, you only had to get a statement if you asked for it. It wasn't required that a benefit statement be issued, and the PPA required the department to set forth standards by which regular benefit statements would be disseminated to plan participants. And in fact, Congress asked that the department put out a model of what should be on that benefit statement. Seems to make sense so far. And in 2013, in anticipation of a more robust look at the benefit statement, the department issued an advanced notice of proposed rulemaking. And in fact, they said, we're going to have a rule on benefit statements, but we want to start early to see what you, the regulated community, thinks about whether or not we should put a conversion factor that shows what your assets would convert to in terms of lifetime income. Makes good sense when you think about this as a retirement plan. You want to think about it in a retirement plan sense. And we got about 120 comments. I can summarize the comments in 4 ways. Some people said, mandate that. That's a really good idea. You should really think about it, just as I thought about that defined benefit statement that told me what my retirement income would look like should I retire. Other people said, ooh, don't mandate anything, but there's always going to be a contingent that says, don't mandate anything. There was then a next dimension of what should that conversion factor look like? Just like your defined benefit, the conversion factor could say, if you retired today and you're in a final pay plan, your salary was X, this is what you would get today. Other people say, but I'm going to work until I'm 65, so I want to forecast pay increases, or in the case of the 401k plan, savings increases, and I want to forecast earnings so that I know by the time I get to 65, this or whatever retirement age I might pick, this is the assets I would have that would convert to income. So people are all over the mandate, don't mandate, do it as today, forecast. And each has its strengths and weaknesses. There's a concern that for those people who look at today's balance, if you're young and low balanced, you go, whoa, that won't even pay my cell phone bill. At which point you give up. The mountain's too high to climb. I'm just not going to climb that mountain. There's a concern about that. On the other hand, it says, I really need to pay that cell phone bill, so I better start saving more. And is it an incentive to save more? We don't have an opinion yet, but I can tell you that the opinions were all over the board. And it's an important component in looking at a benefit statement as we look at converting a supplemental savings plan to a retirement plan. The second area that the department is looking at is target date funds. Now I'm going to step back into my chief investment officer's role for a while. We, at my last corporate job, typical of many corporations in America, recognized that we had three kinds of savers in our 401k plan. We had some savers that said, I don't know what to do. Please just do it for me. They love those auto features, and we auto-enrolled them. We have other people who said, Alliant Tech System is an aerospace and defense company. We literally had rocket scientists, and the rocket scientist said, I'm a rocket scientist in every aspect of my life. I want to do everything. In fact, can we have gold? Can we have commodity funds? I want the most complicated and sophisticated investment structure. And then there was a core in the middle who just said, I kind of want to do it by myself. I don't know that I want a target date fund, but could you make it simple for me? So we had three kinds of savers. And I want to talk for a minute then about the role of a target date fund. We not only auto-enrolled people at our company, but we defaulted people into a target date fund. A target date fund is a great feature of a multi-asset class fund that changes the risk profile, or we call it the glide path, as you reach your retirement years. The problem that we see with target date funds is we use the same name, but they don't all mean the same thing. And so if you look inside a target date fund, you'd find that you could have some funds that reach a 2015 fund, I'm going to take as an example, that could have 20% in equities. And you can have others that have 60% in equities. If they're your most volatile asset class, they're not really the same, but they have the same name. So the SEC, I know, and the Department of Labor have both been concerned, particularly as you saw the change in investment patterns as a result of the market declines in 2008, to making sure that investors and plan participants really understood what they were investing in when they entered into a target date fund. And we're aligned both at the commission and the department in making sure that the prospectus that is issued for registered products has the same kinds of disclosures that our plan disclosures have. So we've been working together to look at a system, an alternative systems that describe the riskiness or profile target date funds. In my plan world, target date funds were up to about a third of the plan assets in my last employer, and are projected to be about a half of the plan assets in another 5 years because of this auto enrollment and auto default feature. We're working mutually with you to look at the right kind of disclosures, and you've got a comment period I think that you're looking at. If you open your comment period, we'll reopen our comment period. I think what's important both for the lifetime income disclosures and for target date funds is they both have some uncertainty around them. And if you can reduce uncertainty, you can increase participation, because people don't know how to manage risks, so they don't manage. And so those are two areas where we're really looking at taking steps to reduce uncertainty for plan participants. I want to comment quickly on a third area. Remember, I mentioned we do have rocket scientists at my last employer, and they want sophisticated investment structures, and therein lie why we put in a brokerage window. When we streamlined our core fund lineup to get plan participants to focus on asset allocation, not manager selection, by streamlining asset classes and having few managers in each asset class, We had a brokerage window for those people who wanted sophisticated investment portfolios. But brokerage windows come at a concern. And the concern was who is responsible as a fiduciary for the investments inside the brokerage window. And at present, the department has said the plan sponsor is a fiduciary with respect to the selection of the brokerage window, but not what's inside the window. And when we issued some fee disclosure several years ago, there was a concern about what kind of disclosure did we have to have about investments inside brokerage windows. And they can take all forms. Brokerage windows can cover every security in the marketplace, only mutual funds, only certain families of mutual funds. But the key is it became clear to the department that they didn't really understand how brokerage funds were used or how they thought they should be used. So as a result of the activities that occurred around fee disclosure, the department is about to embark on a request for information to get a sense of how brokerage windows are being used in a fund structure. And I just wanted to give you an idea of a sense of the kinds of questions the department is looking into. And, how are they used? Who uses them? What's inside the brokerage window? How do plan participants use them? What kind of disclosures do you have? How much is allocated to the brokerage windows? To really get a sense of what kind of window is it, who's in it, and who's watching it, to really ensure that the protections, that the fiduciary protections, are being appropriately allocated. These are three examples of what I think are uncertainties that exist for plan participants. And if, as I said earlier, I think uncertainties create risks that people don't know how to manage. And if we reduce some of those uncertainties, I think it will lead to an increased usage and participation in plans. I wanted to end with one final comment. I think Susan mentioned that in the 70s, I came to work for the Carter Commission on Pension Policy. And one of the things that occurred in 1978 was people took a look at who was covered by plans. 50% of the people were covered by plans in 1978. David just told us 50% of people are covered by plans, corporate plans, today. It is an intractable problem. It has been an intractable problem, and it requires all of us to think out of the box to change the problem. That relying on the corporate structure hasn't worked, and that we certainly at the department want everyone to be covered by retirement and save for an adequate future, and we think we've got some things that are working. Thanks.
Thanks, Judy. The juxtaposing the remarks of David and Judy, it was very interesting to me because David talked a lot about getting people to act by doing things to them automatically or having things happen to them automatically and then using an opt-out. Judy talked an awful lot about the importance of information, and both resonate with me. So the SEC is very much an information agency. We're sort of, it's not the only thing we're about, but to a large degree, we're all about getting information out there to people so they can make informed decisions, to investors. At the same time, we struggle with the whole information overload problem, that if you give people too much information, they don't act. And so that's what animated our mutual fund summary prospectus initiative, creating a short form document that people might actually read. It's also, I think, the issue that both Labor and SEC, or one of the issues that we're both working with on the target date fund initiative. So Judy mentioned a possible reopening of the comment period. Just to let you know what that's about, one of the cornerstones of the proposal, I think both proposals out of both agencies, was that the target date funds would show their glide path, how your asset allocation would change over time as you near and pass retirement. So it would show the question, are you 80% in equity at retirement, or are you 30% in equity at retirement? We at the SEC have a group called the Investor Advisory Committee that was formed. It's mandated and formed by the Dodd-Frank law, and they provide SEC advice about initiatives that might help investors. They recently recommended to the commission that the commission consider developing a glide path illustration for target date funds that would be based not on asset classes, say stocks, bonds, cash, but on level of a standard, some sort of standardized measure of fund risk. Our chair has indicated in a letter that was made public and is available on our website that she's asked the staff to develop for the commission's consideration a draft request for additional comment in that area. So that's currently under consideration. And with that, I'll now turn it over to John Farinacci. Thanks,
Thank you.
John.
Thank you. Good morning. It's a pleasure to speak with you today about such an important issue, how to improve retirement outcomes for Americans. Hopefully I can add another perspective to the discussion. Given my industry background, I thought it'd be helpful to talk about the trends that I've seen over the past 10 plus years, mostly from a 401k record keeper, a DC record keeper perspective, and from an asset manager perspective. Also, since joining SEC 2 years ago, I'm involved in various examinations, investigations, many of which are focused on mutual funds, which, as you know, are a predominant vehicle within the 401ks. For example, one of the asset management unit's priority areas, which I spend a good portion of my time on, is to focus on board governance and fees, including payments that go to intermediaries, which would include DC plans. Many would say that the trends or evolution in the 401k business over the past 10 years have had a positive influence on a number of participants or the level of assets held by participants. I'm not suggesting this is enough. I think David talked about if you don't have the ability to save, or in the case of senior citizens, they may not even apply to a lot of the areas I'm going to talk about. But if you are in a 401k plan, I think a lot of changes over the 10 plus years have been good for shareholders. But before I go any further, I thought it'd be helpful just take a minute and talk about the business model. As I'm sure you know, a company that has a 401k plan has a number of employees or participants that invest in the plan, and the plan sponsor plays a critical role. And for today's discussion, the couple of areas that I think are relevant are that they are the ones that pick the investment choices within the plan, and they're the ones that are in the negotiations when they're deciding whether to keep the record keeper or to get a different record keeper. The record keepers, to give a few names such as Hewitt, Fidelity, Vanguard, T. Rowe, Principal, provide record keeping and administration for the plan. Then there's the investment advisors who provide management of the investment options in the 401k. Now the record keeper, it's funny, before we started this session, Jude and I were talking about, we like the term follow the money. So being a CFO, I tend to do that. The record keeper can get paid through plan or participant fees, but a more significant amount of the fees come to the record keepers come from the mutual funds, the mutual fund advisor, or its affiliates. And these are often in the form of 12B1s, revenue sharing, and sub-TA fees. And it's important to note, this area of the business, the retirement business, including the 401k segment, is a significant growth opportunity for asset managers. And it's also an area that once they get the assets, they recognize that the assets can stay with them for a long time. So there's a huge focus being put in this area. You know, you read about all the time where there's additional sales force or focus areas within these asset managers to go after these assets. And there's various sources on how much is out there, but at least what I saw, there's $3 to $4 trillion in 401k assets. So it's a big focus area. Many record keepers I mentioned, for example, Vanguard, T. Rowe, Fidelity, and JP Morgan, to name a few, also have an affiliated investment advisor, which leads to my first point. For obvious reasons, a record keeper would rather have more of their proprietary fund assets in these plans than to put in a non-proprietary fund, but it's not their decision. If you go back 10 plus years, I believe you'd find, if you looked at the percent of assets in plans, you'd find that there was a higher percent of proprietary funds and assets held by record keepers than we'd see today. I believe plan sponsors recognized that to rationalize the funds they selected across the various investment mandates, no one fund family could really fill the gap. Now, I haven't worked, Judy perhaps has, I haven't worked or been exposed to the decision-making process regarding fund selection, but I'm sure they look at a number of factors, quantitative and perhaps qualitative factors, when determining which funds to include. And as mentioned, it's hard to rationalize one family can make the final cut in all of these areas, whether it be performance, risk, or manager tenure, to name a few. The percent decline in proprietary funds has continued over the years. It's resulted, and you know, if it has resulted with better investment choices for the participants, again, this is a good thing given that hopefully they've experienced better performance than they would have otherwise and increased their assets. Over the same time period, I've also seen a change in plan sponsors. I'm not sure how I'd characterize this. I don't know if it's their level of expertise or stronger due diligence, or did they put more resources towards this function, either in-house or through third parties. And one thing I definitely saw was the use of more use of consultants in this area. And I think this, as well as some of the DOL efforts, has been part of the reason why the costs for people to be in 401ks have declined over the years. This has evolved to a point where, say, 10, 15 years ago, it would be common to see participant fees and plan level fees in large plans, but you no longer see that. You see that many of the large and even going down a little bit to the mid-market, you won't see participant fees or plan level fees. The focus on pricing has also found its way into investment options. The investment options, as I mentioned before, in most cases mutual funds selected by the plan sponsors have lower fees than they did 10 years ago. In a 2013 ICI white paper, it noted that 401k plan participants have incurred for investing in mutual funds have declined substantially in the past 15 years. So plan sponsors are more focused on the total cost of the participant, including those embedded into the fund expense ratio. And with that, the plan sponsors clearly recognize now the amount of money that goes to the record keeper from the mutual funds and their affiliates as well. So when they're negotiating with record keepers, they often focus on the total cost of the plan and how it translates to cost per participant. This pricing has migrated. It started at the large plans, and it's gone into the mid plans. So just to give an example, I'm sure most of you know this, if I'm a plan and my assets double between over a 3 or 4 year period, but my participants are the same, if the record keeper is getting an asset-based fee, their fees per participant doubled as well. So the plan sponsors have really forced the discussion into the per participant side. Recent Hewitt study suggested that plan expenses are on the top of mind with many employers. In recent years, fees have gained significant exposure. So how have record keepers responded to this? To be competitive, plan sponsors have proposed and record keepers have agreed to include lower fee mutual funds or lower fee share classes, often referred to as retirement share classes. So this has caused an influx of index funds and retirement share classes, and the latter often have lower fees than the existing share classes of a mutual fund. So to give you a sense, give you some context on how this has really grown, the retirement share class. I looked at Morningstar the other day, and there's 3,500 share classes that are characterized, somewhere around there, characterized as retirement. And 90% of those have been launched since 2003. So a lot of this has happened in the last 10 years. And these retirement share classes, as I mentioned, generally have a lower fee. So to provide some context on that, when you look at 2013 through Morningstar, you see that the American Funds Euro-Pacific Fund R6 share class had the highest level of sales in 2013. So this share class had an expense ratio of 50 basis points or 0.5%, whereas if you were going into the corresponding A share class, that would have been closer to 90 basis points. More than 70% higher was the expense ratio, which, as you know, goes to the bottom line of performance and increase in assets. And as plans have negotiated this, something that has continued to grow over the years, if the plan cannot achieve a certain cost per participant by putting in lower cost funds and lower cost share classes, the record keeper actually pays or covers certain plan expenses, often referred to as plan expense reimbursements. So there's been a huge push on the expenses and the reduction in expenses over the last 10 years. Over the past decade, I think what's also gone in tandem with the reduction in the proprietary fund assets is the number of selections that a participant has to face. So if there's, I think the average, I read in a study recently, was 13 funds. I was talking to Judy. I think she had 7 investment options in one of her plans. And this is a good thing if you believe that when individuals are confronted with too much choice, they make no choice at all. So it's been simplified and it's logical. You may have a few target date funds, and then you'll have funds that will cover the various mandates: large cap, mid cap, international. We've talked a bit about the employers have increased efforts to automate their 401k plans and default employees through auto enrollment, auto contribution, and auto rebalancing. Of course, with the help of the Pension Protection Act in 2006. And David talked a lot about the benefits there. You know, one of the things, as again most of you know, is they move from the opt-in to the opt-out dynamic. Recent study by Hewitt said that this has become a standard for many plans. It's also noted that auto enrollment has helped to increase participation rates. That's the good news, but it hasn't really had a huge effect because this only applies to new employees that are coming in. So generally speaking, it's not going to address the existing employees that haven't enrolled when they join the company or they've opted out. I think soon after the Pension Protection Act, the DOL issued an opinion which allowed the use of target date funds as the qualified default investment option. So Judy mentioned that in her plan that she managed, when people would be automatically put into a target date fund. So there was a lot of conversation about the pros and cons of that. But one thing for sure, as a result of this, target date funds have increased significantly in the past few years, well, since the 2006 time. To give you a sense of that, in 2006, there were $107 billion in target date funds, and that's now close to $600 billion in 2013. So again, lots of pros and cons in there. I was happy to see that there was a DOL release last year which outlined important questions and due diligence for plan sponsors to focus on as they considered target date funds. Finally, relative to 401k, I think investor education, what I had seen over the years I was in the industry, certainly has increased. The companies were more open to letting record keepers come in and help with that education. And a recent study showed that even just on-site seminars, workshops, and meetings were extremely effective in helping people understand their options and was very positive in getting people to get into the 401k plans. So just one other thing I just wanted to mention, I've talked a lot about the 401k business, but it's hard to talk about this without talking about IRA rollovers. The commissioner talked about the baby boom generation, and so there's a lot of individuals that have either left their job or are leaving their job, and these rollovers, he talked a little bit about the focus of the commission. I just want to expand just a little bit on that, where he talked about are individuals being moved from a 401k plan to a rollover IRA and paying commissions. If I can tie in what I said before, I talked about the share classes. You know, the American Fund share class was 50 basis points, and there's 83 in the other. That's another area that we should ask questions about. Were they informed? Was it disclosed? If they move from the 401k, a lot of times they can't stay in those lower fee retirement share classes. So given the time, I think I'll stop here and
John, thanks for that. You touched on a couple new issues that I think are important. You touched on the whole financial literacy, financial education issue. You also got in at the very end to the whole issue of advice being given to participants. Great issues, and wish we had more time to to hone in on them. At this point, I am going to turn it to Jeremy, who's going to give us kind of the view from the behavioral economist's point of view, which hopefully will give us some insights into what motivates investors as they make their decisions. With that, Jeremy?
Thanks, Susan. So, like Susan said, I'm going to put on my economist hat and give you a quick survey of what academic research says about various mechanisms for increasing participation in retirement plans. So, I'm going to start with something that's been mentioned a couple of times already, and that is auto enrollment, or the opt-out regime. It's probably not surprising to anyone that academic research has found that this has a very substantial effect on levels of enrollment. So one study from about 10 to 15 years ago, for example, found that having an auto enrollment regime increases participation by about 50%. So in other words, an additional 50% of new employees enrolled as a result of the opt-out regime. Now, there's an extreme version of auto enrollment, and that is mandatory enrollment, which exists in privatized social security systems in other countries like Australia, Chile, and Sweden. There's obvious pros and cons there. I wanted to next mention simplifying plans as a mechanism for getting people to participate. So John made mention of the number of investment choices that were available to someone in the so-called paradox of choice, where if you have too many options, that can serve as a deterrent to people acting. And a pretty interesting academic study found that in fact fewer investment choices led to higher rates of participation. Now, the magnitude of the effect was not that large. So to be specific, an additional 10 options resulted in 1.5 to 2% fewer employees participating. So although there was an effect there, it wasn't overly large in terms of magnitude. Now, another kind of simplification exists in a mechanism which is known in some places as quick enrollment. And what quick enrollment does is it simplifies the decision from one where you have to decide lots of different parameters like your contribution rate, your asset allocation, and so on, to simply just a binary choice where you decide whether or not to enroll. And if you do enroll, you can enroll at a fixed contribution rate with a fixed asset allocation. And what research has found is that this sort of simplification results in an additional 10 to 20% of employees participating in plans. I next want to mention what I'm going to label as execution aids, which help investors to remember to enroll or make a decision. And one possible decision-making regime is what's known as active decisions, whereby people do not have a default. So in other words, when an employee is hired, they must return a paper and pencil form to the employer within 30 days of their hire that indicates whether or not they're going to enroll in the plan. And once again, what research has found is that this sort of active decision regime causes about 28% of additional employees to participate in the plan. Now, one strength of this active decision regime is clearly that there's no unwitting gravitation to default options. So it could be with auto enrollment that people are enrolled even though they don't want to be, but they're just too lazy to opt out. An additional execution aid that I wanted to mention was a couple of researchers put together a one-page flyer which described in a simplified way the step-by-step process for enrolling in the retirement plan. And what these researchers found is that resulted in an additional 12 to 21% of people enrolling. And then finally, under the theme of reducing people's psychological costs or barriers to enrolling, I wanted to mention financial education as one general way of addressing the cognitive problems that people face when making financial decisions. And what the evidence suggests is that, as John made mention of just a second ago, is that employer-sponsored financial seminars may promote savings, although the evidence is somewhat mixed. So there's an indication that people after a seminar indicate that they will save, but there's a question as to whether or not they actually go out and do. Generally, financial literacy is related to retirement planning, but I think a lot more research needs to be done on whether or not financial education, let's say in our school system, results in better savings outcomes. So the final theme that I wanted to talk about is financial incentives related to retirement investment. And the first is traditional employer matching. So in other words, whenever you contribute to your employer's plan, your employer matches that contribution up to some threshold of your income. Now, what the research has found is that employer matching does boost retirement plan participation, but the magnitude is not as large as things like auto enrollment. So to be specific, the general finding is that, roughly speaking, a 25% increase in matching per dollar invested in the plan results in roughly an additional 5% of employees participating. And the last topic that I wanted to mention under the general topic of financial incentives is what I'm going to refer to as financial fringe benefits. So certain benefits that you might get from participating in a plan that are financial in nature. So the first one is 401k loans or 401k debit cards. So there's one natural idea is that the availability of 401k loans enables you to have your savings be more liquid in the sense that you can withdraw them at least temporarily, and that may boost plan participation. And what research has found is that that seems to be the case, that it does increase participation by around 5%, the availability of 401k loans. However, there's a clear cost to having a 401k loan, and that is that it might encourage people to dissave and withdraw their savings early, particularly if they default on the loan. So the net effect of the availability of a 401k loan, according to academic research, is unclear. And the very last thing that I wanted to mention under fringe benefits is these lotteries that exist in savings accounts in different credit unions in different states around the nation. There's been some academic research that's been done to indicate that the availability of a lottery actually increases savings, particularly among men, low savers, and perhaps not surprisingly, people who play lotteries. And there's been some discussion of migrating that sort of thing over to 401ks. So.
Could I point out something just quickly? There's one class of people that we haven't talked about. We talked about people who are employed and don't have the opportunity to save. But we have a lot of younger people now who are working as independent contractors or freelancers and the like. And one of the things that we need to do going forward is to make sure that we have opportunities for them to save, preferably using the same kind of techniques that we heard from Jeremy and from the others.
Well, if there are no further comments or questions, I would thank my fellow panelists. You were great, and thank the audience for your listening to us.